Hi everyone, I'm Sherry Borshoff with Bastion Business and Tax Services, where we help business owners and investors protect, organize, and strategically grow their financial fortress through proactive tax planning. And today we're talking about one of the most powerful wealth building tools in the tax code, the 1031 exchange. What is a 1031 exchange? It's Section 1031 in the IRC. That's Internal Revenue Code in plain English. It allows to sell an investment or a business property and defer paying capital gains taxes by reinvesting the proceeds in another qualifying property. Notice that I said defer. Taxes, not eliminate them. This is a very important distinction. Gain generally carries forward into the new property until you eventually sell without another exchange, or pass away and your heirs receive a stepped-up in basis. This is why real estate investors use 1031 exchanges to continue growing wealth without losing large chunks of equity to taxes every time they upgrade properties. What a 1031 exchange is not. Now, let me be very clear about some of the myths. Myth number one is it's not tax-free. It is a deferral of taxes. The IRS basically continues rolling your investment forward. Myth number two, I can exchange for a personal residence. No, you cannot. Your primary home does not qualify. It has to be an investment property, a rental property, a commercial property, or property used in a trade or business. I can take the money and buy another property later. Absolutely not. If you touch the proceeds from the sale, you generally destroy the exchange. The money must be held by a qualified intermediary. Myth number four, I can flip houses using 1031 exchanges. Generally, the answer to that question is no. Properties primarily held for resale are considered dealer property, not investment property. The intent matters. That means long-term investment intent matters. Rental activity matters. Documentation matters. And timing matters. What types of property qualify? The term like-kind confuses people. In real estate, like-kind is actually a little more broad than what you would expect. You can exchange a rental house for an apartment building. You can exchange farmland for commercial property for raw land, a duplex for industrial property, as long as both properties are located in the United States and held for investment or business purposes. There's how you execute a 1031 exchange. Here are the mechanics, so to speak. This is where people accidentally break the rules. Step number one, sell the original property. Before closing, you need a qualified intermediary, also called a QI for short. This is not your CPA, it's not your attorney, it's not your realtor, or yourself. QI holds the funds during the exchange process. If the money hits your bank account first, the exchange is dead. Step two, you have to identify your replacement property. You have 45 days from the date you sell your property to identify replacement property in writing. This deadline is strict. The IRS does not care about vacations, lender delays, weekends, or I forgot. Step three, close on the new property. You have 180 days from the sale date of the original property to complete the purchase of the replacement property. Again, it's a strict deadline. How to avoid paying tax now? To fully defer taxes, the replacement property should generally be equal or greater in value, and all proceeds should be reinvested. If you receive any cash back, that may create a taxable boot. Boot can include cash received, a debt reduction, or non-like-kind property. Common mistakes. Here are some common mistakes that are the biggest landmines we see. Waiting too long to involve professionals. 1031 exchange must be structured before closing. Touching the money before you take possession of the proceeds. Never take possession of the proceeds. You have to have the 1031 structure in place. Exchanging personal property for vacation homes, residences, those have special rules. Poor documentation of investment intent, especially with short holding periods. You want to document the intent of why you bought the property and what the property was going to be for if you're doing an exchange within a short period of time. Upon death, the heirs may receive a step-up in basis, potentially eliminating deferred capital gains. This is one reason that real estate has historically been a powerful wealth-building vehicle. A properly executed 1031 exchange can be an incredible tax strategy, but poorly executed one can create a massive unexpected tax bill. So before you sell investment property, make certain that you involve your tax strategist, involve a qualified intermediary, understand the rules before closing, because once the sale happens incorrectly, there is usually no undo button. Yeah. If you found this helpful, like this video, subscribe to this channel. I'll have more things like this coming up in the near future. Share it with another investor or business owner trying to build their financial fortress. And if you want help with proactive tax planning or investment strategy, reach out to us at Bastion Business and Tax Services. I'm Sherry Borshoff, and I'll see you in the next video, where we can also explain how Delaware trust factors into the strategy. But in the next video, we'll talk about that. So like and subscribe, and we'll get you on the next video. Thanks for watching.